Trading is a lonely game, so grab a coffee and let's change that. Roll the intro. Alright, don't adjust your radio set, you're right on time. Coming to you from Vice Cities, Hot 44 FM, your premier trading show, the Bullish Café. Ladies and gentlemen, welcome to the Bullish Café. Alright, what I want to do in this episode is step back a little bit. We're gonna keep it macro. That means, before we get into any pairs and talk about lower time frame details and executions, I think it's important to understand first the higher time frame context. Of course, going into the new year, we have to know where we stand. Because as much as we like to watch our 1 hour and 15-minute time frames catch speedy entries, they always have to submit to the bigger context. So starting with that, the truth is, we've had some rather interesting price action on dollar recently. Some of it expected, some of it a bit mixed, It's been quite a handful since what? October? Well, due to a lot of macroeconomic and geopolitical events that we all know about. But the impact on the market is clearly visible, as we will see on the charts. So, before jumping straight into lower time frames, let's read the bigger picture first, and we'll start with the dollar index. I'm going to walk through the higher time frames, starting from the yearly. Yes, you heard that right. It is February 2026 open is still fresh, so we have to start with the yearly outlook first. Then the monthly, then weekly, and that's our top-down analysis. And just see what we have. Just let price tell its story, and we'll take it easy. We will go as far as our understanding goes, and that's more than enough. The framework is clear. The higher time frame bias is essential as your first step. Then comes the context, then the narrative, then the execution. And everything will fall in line as we go. So let's begin with the dollar. Alright, now we're looking at the yearly chart. That is the 12-month time frame for DXY. Yes, this is very macro. Every candlestick represents a full year here. So what are we doing here? What we're doing here is checking our positioning on the large scale, and that should be your very first step of your preparation for the year. It is February in time of recording, so as I said, everything is still fresh. So we're looking at a general uptrend for the past 12 years, no doubt about it. How do we know? We outline the following. Price has been continuously breaking above previous swing highs, right here and here. Yes, up until here as well. That is the most recent one. And of course, it comes with retracements lower after every bullish push. And we could be in one right now as we speak. At the same time, when breaking previous swing highs, price is creating bullish fair value gaps. These ones right here. And notice, that is exactly where the retracements end. And price resumes the bullish expansion. Again, we could be in one right now as we speak. Looking at previous price action, analyzing it the way we analyze it, it gives us a good baseline on what to expect next. It helps us big time with our anticipation skills. Still, it needs a little bit of more detailing, and for that, we have a plethora of tools that we will use and explain. So what do we have currently? Where does the current marketplace stand? Simply, We're just trying to deal with the last yearly bullish fair value gap. That is all we need to form our probabilities. We just look at previous candle close. The 2025 yearly candle closed inside that last bullish fair value gap. Now, to understand what this tells us, we're gonna go quickly to the side right here. Education. No, wait. Yoshimitsu. What are we doing, man? The fair value gap acts in two aspects. 1. Magnet for retracement and manipulation. Therefore, whenever the market fails to continue expansion or starts retracing or looks for manipulation, be sure that price will magnet towards the nearest valid fair value gap. And then you wait for respect to continue or disrespect for possible reversal or consolidation. And then we have the second aspect. It's a signal for one directional volume, and that is self-explanatory. A fair value gap in a given direction indicates that price is sharply moving towards that direction until reaching the next key level. Simple as that. That's how you identify your current trend. A bullish fair value gap should create another bullish fair value gap, then another, until it doesn't do it no more. Remember? That's exactly what we used to identify this bullish uptrend right here. So now that we're dealing with a fair value gap, of course, what should happen next? Well, when price reacts to a fair value gap, we have three scenarios. Number 1, touch and respect. That's the best case scenario. If you're biased towards that direction, you want price to get that quick reject from it. Leave a nice rejection wick there. Looks like price is getting electrocuted. Doesn't spend much time inside that zone and quickly rejects away. It's easily identified by closing outside the fair value gap. So in this scenario, the fair value gap holds, and it has the highest potential of providing the next expansion in your direction. Scenario number 2, touch and disrespect. That is when price does not produce that sharp turn, that quick rejection from the fair value gap. It's identified by closing inside the fair value gap in disrespect. And of course, this disrespect candle is important, leaving a disrespect low or high. In this case, what now? Boom, 2 possibilities. It's either gonna be a 2-candle rejection or a consolidation. A 2-candle rejection setup is expected when this previous candle closes in disrespect, leaving a disrespect low inside the fair value gap. Now, your continuation possibility is now in the hands of the disrespect low right there. That's where you should anticipate your manipulation and then expansion. In the case of a consolidation, well, that means nothing happens for the moment. Basically, consolidation happens after reaching a major key level or when there's not enough liquidity to move the market. So price just consolidates in a mean to generate new liquidity to fuel the next push. And your best option is to not participate. Otherwise, you will become the liquidity. And finally, scenario number 3 is a violation. This is when price completely disregards the fair value gap. I mean absolute violation. And high likely signals a reversal. In this case, you wait for a new fair value gap to form on the opposite direction and go with it, repeating the same exact classification we're talking about. Why I'm telling you this? Because whether you notice it or not, you'll always be dealing with a fair value gap in your everyday trading. Fair value gaps are one of, if not the most, important element of price action. It's always telling us something we need to know. Whenever it's newly created, when it holds, when it's disrespected, when it fails to push for a new fair value gap, when it's violated for a reversal. Always look at the fair value gaps. And with this classification, you'll be able to position yourself in the market accurately and line up your probabilities with more confidence. And all of this can be applied in any time frame given, from the 1-minute chart up to the yearly chart even, like what we're seeing here. So let's start applying. As we outlined, during previous years, it's been bullish, breaking and closing above previous swing highs. Previous yearly candle closed inside the last yearly bullish fair value gap in a disrespect candle. Quite uncomfortable, yes, but good thing 2 minutes ago we just learned what it means. It means that disrespect low from 2025 would automatically be the next target by that rule, which was indeed reached in January. And currently, we need to monitor if it's gonna be a sweep on that low to reverse higher or a continuation lower, which is also likely to happen. I mean, unless these people in some governments get their act together. And time to move on to the monthly chart. Okay, this is the monthly chart before February open, and this is what it says. And alright, I've been complaining about it for the past 6 months in my articles on LinkedIn and Substack, which you should check out. I covered the year of 2025 in weekly articles. They're fantastic. If you're a reader, you will like it. Technically, there's absolutely nothing going on. From June 2025 and up to today, we've been consolidating inside that yearly bullish fair value gap. And no direction is clear for now, and it perfectly translates the state of the US dollar and government in the past few months. Shutdowns, inflation, unemployment, interest rate confusion, weird decisions, there it is. Also with the AI investments, as we've seen recently, the major companies' earnings numbers are positive, yet their stocks keep going down. Contradictory, right? Why? It's confusion and fear. People don't know what to expect from these huge AI investments. What is the ROI? Anyways, it's very important to note that you can get as technical as you like, and yes please, you have to, but still, when fundamentals are shaky, the market reacts to that in a more sensitive way than we think. So it is essential to stay very, very cautious. Now let's see what we have here. The yearly bullish fair value gap. Big long horizontal consolidation inside it. Technically very logical. 2025 closed in disrespect of that bullish fair value gap. So here's the disrespect low. January indeed reached down to it, and now it's February open. Notice how we're slowly zooming in on the current marketplace, little by little. Now, this is the initial consolidation, initial range. One obvious thing that pops out, it's the liquidity, both buy side and sell side. What does this mean? Short answer, where could traders' stop losses possibly be located? Liquidity is the answer to that question. And long answer, it means that following this horizontal price action, traders are trapped both ways, like this. Alright, this is the idea behind sweep and liquidity during consolidation. If we take the original consolidation, the horizontal range between these two levels right here, last swing high and last swing low from monthly, what followed devastated any attempt for breakout traders, whom we know would like to place their orders on the swing high and low to catch the breakout. Every single time, it's a fake breakout. Price taps below the swing low, fills these sell orders, and returns back into the range. And now they're trapped. And of course, their stop losses would be placed maximum above the swing high and targeting whatever. And eventually, the market will take their money from their failed sell entry. And we say that price collected that sell-side liquidity. And look, right after that, price did the exact same thing again for breakout buyers this time. Buy orders executed, stop losses would be below the swing low, and then back into the range again. Buyers are trapped, and boom, hits their stop losses. And this can keep going on and on for as much as price needs. And that's how you can read your consolidation and how price keeps generating liquidity from both sides, taking stop losses from traders who are trapped. What should we do? Oh, I'll tell you what we should do when we get to it. And by the way, we did some good trading during these months, and they're reported in details in the articles. Check our LinkedIn to see the lower time frame breakdown of each of these liquidity sweeps. And since we're doing this ping-pong stop-loss hunt back and forth, sweep buy side, back into the range, sweep sell side, back into the range, the market is two-sided. And when it's two-sided, it's low probability. That's just the way it is. You can trade it, but just be aware of the probabilities. So okay, we get it. Consolidation, horizontal, very boring. When does it end? Simply, it ends when one side overpowers the other. So there you have it. We explained how the higher time frame is actually, and unfortunately, at a low probability from a fundamental point of view, using the current news events and the godforsaken state of the world, I guess, and from a technical point of view, simply by locating the possible big stop losses and identifying that price is hunting them both ways. So this was a higher time frame overview to start the year. On the next episode, we will get more into detail in lower time frames for this previous week. A lot of interesting stuff down there, so stay tuned. Until then, take it easy. It's just another day at the charts. The Bullish Café signs off, and back to you, Rico. Play some music. Oh yeah, this next record is for you to get down at the Malibu and apologize in the morning.
But the top stays on.